Alright, so talking about buying and selling, calls and puts. We're looking at Facebook, April 25th here on my options chain. And we're using the example of the $63 puts. If I was just wanting to buy these so that I could sell them for a profit, I would buy to open. With puts, don't sell to open puts. Sell to open puts means you are giving somebody else the right to sell you their shares at the strike price. That stock drops and falls apart. Guess who's stuck with shares at a higher price? And yet have to have the money to pay for those. Now, I sell calls all the time. I will sell to open calls, covered calls. Sometimes I do naked calls. Sometimes I'm doing that with spreads, but I don't like to do that with puts. I don't want the obligation to have to buy something from somebody. I don't mind having to sell them something, but I don't want to buy something from them. So if I was going to buy 5 of these contracts at 305, I would use a limit order, and I would hit buy to open. When I hit buy to open, I would see over here in the time and sales, 5 contracts go off at 305. Now, Facebook as a stock trades up until 8 p.m. in the after hours, even though the market closes at 4. What's the latest I can buy these contracts? Indice options you can trade until 4:15, 15 minutes after the close. Equity options, for the closing bell, if you didn't fill, you didn't get in. So 3:59 and 59 seconds, really. Eastern time. Now, we talked about buy to open. Now, assume I don't want dog to get confused. Assume I didn't just say we bought them at 305. Let's say we want to sell them. And we wanted to guarantee we were going to get to sell them and be out now. Using a limit order, what price would we sell them at? Would we want our 5 to be in line with 224 other contracts? Or would we want to make sure that we get filled at 296 and not 292 or 289 and 280? If it were me, now you can do what you want. You can sit on the ask and watch the bid fall away. You can sit on the ask and literally watch the bid go away. Or you can sell on the bid and guarantee your exit. Now I've got 2 options for selling. I can sell to close and sell to open. What do I want to do here? I want to get rid of these. I want out of them right now. Sell to close. For most of you, you need to write this down on a little index card, tape it to your desk. Real simple. These 2 lines. Line 1, buy to open. Line 2, sell to close. And just let that serve as a reminder, because sometimes if you go to sell to open and you don't have the proper options tier approval, your broker will just tell you you're not allowed to do that. But when you get up to the experience level and whatnot that you do have tier 3, tier 4 options approval, and you accidentally sell to close or sell to open instead of selling to close, you've just initiated a contract. You've initiated somebody else having either the right to buy or the right to sell you something at a certain price. That's when options, I won't say when they can get dangerous, but when they can get dangerous if you don't have the capital to support what you just did. Okay? Buy to open, sell to close. If you want to ensure that you get in, you buy the ask. If you want to ensure you get out, you sell on the bid. Everybody understand that? And does that mean that sometimes you're selling for less than you could have gotten filled for, or you're buying for more than you could have gotten filled for? Yes. But in my experience, A, there's nothing worse than putting your bid in, watching it run, and you not getting filled. Or B, getting a partial fill, paying the broker fees, and watching it run with not enough to really do well if you sell on the move you were expecting. They don't have it like this, dog, but are you using Scottrade Elite or the Scottrade quote thing? I use the quote one. Yeah. You can still select in that order form, buy to open, sell to close. I don't have that platform up right now. Streaming quotes, that's what it's called. Scottrader streaming quotes. Well, I never advise anybody to buy anything on margin because you're buying on a loan when you buy on margin. I never advise people to do it, and people that I know are doing it, usually I ask them to leave my service because it's a higher level of danger, and when things go against you, you could actually end up owing money. So I just want to be honest with that. But I'm just going to bring up a generic one for you, dog, here. Okay? This is what you're used to. You can select on market side, buy to open, buy to close, sell to open, sell to close. Right? And this is what you're used to, this order form here. So I could buy to open. This is just FCX, okay, $35 call. If I want 10 of them, there's the ask, 26. I can put it in on the ask. Buy to open, place order. Sell to close. If I wanted to sell them on the bid, bid's 24. There's my 24. Place order. I don't like to buy them from their options chain. I like to have these little orders open, tons of them, all over the place. Well, I don't have Elite open, and I have interference issues with Elite freezing up when I have Thinkorswim or E-Trade Pro up. But it's really no different. You just select buy to open. Instead of having a button, buy open, sell close, or sell, yeah, buy open, sell close, you just select it. The same way, it's just it looks a little bit different. Now I want to talk about an options chain. Here's an options chain. This options chain is for Goldman Sachs. If you're using TD Ameritrade and you're looking at the options chain when you open it up, The red ones are different weeklies. The gray ones are the monthlies. When I swing trade, I prefer to swing trade the monthlies. So let's say that we were looking at a swing trade for May on Goldman Sachs. And let's say that we were looking here at the 165 call. What are two things right away that I need to take note of? Two of the values, and let me tell you, if they're not in your options chain, where it says layout here, click that, go to customize. If you're using Thinkorswim, make your current set look like if you're not experienced and have it set the way you want it, and it's just default or whatever, make your set look like my set. Delta, gamma, theta, net change, volume, open interest, last X. There's a lot more crap you can put on there, but that stuff's important. And there's two of them that are really important right away. Which two are they? Theta delta. Why would I be more concerned with the delta than the gamma? No, the delta is the expected move for the first dollar move in the common stock price. I got to hit the first dollar before I can hit the second dollar, right? Okay, so there's two things that I'm concerned with right away. How much do I make if this thing moves a dollar? That's my delta. And theta, what's my theta? It's another word we use for that. Time decay. When you trade options, unlike a common stock where you're just trading versus the price, with an option you're trading versus price and time. And theta shows you as a percentage what you're going to lose every day that you're in this trade. You won't notice this theta if the stock's moving. When will you notice that theta? When it's going sideways. Let me tell you why, Michael, that I'm saying that. If I'm in Goldman Sachs and it runs up 10 bucks, do you think I'm actually going to notice a 4% difference in my contracts tomorrow? No. But if it sits at the same price tomorrow that it is today, and the next day, and the next day, and the next day, that's going to add up on me pretty quick, isn't it? You know, with common stock, you can get away with holding through consolidation. With options, you shouldn't. Which means when you're entering options, you're not trying to catch the lows. You're trying to catch the times where it breaks above consolidation. And in doing that, you're going to have the likelihood of a more momentum type trade where you don't notice things like time decay. That's why, like on our focus group spreadsheet for Caterpillar, Caterpillar's, I've had 2 horizontal lines marked on that chart for like 3 weeks now, right? And every potential trade I've given has been if it goes above and entering again, in the event that it does start moving again in the afternoon. When you are trading options, you're trading against price and time. What's the theta? What is the theta as it pertains to you? Keep it simple. It's how much you're going to lose tomorrow just for holding it, right? And what is the delta? Again, keep it simple. How much you will make or lose if the stock moves $1. Makes it very simple, doesn't it? You know why I don't even use the gamma very much? And why I rarely ever even talk about it? A, the only people that really do talk about it just try to sound smart. But have you guys ever watched an options chain during the day? Have you ever watched an options chain during the day? And watched the delta and the theta? Do they stay exactly the same? No. You see, the reality is, if I'm in Goldman Sachs and it moves up 50 cents to $160.96, yeah, I'll make about half of that because it only moved half of a dollar. But then if it goes up to 161.96, from whatever the current price is at that point in time, I'll make the delta on that next dollar move. So I really don't need to worry about the gamma because all these values change frequently during the day. So when you're looking at, okay, if this moves $1, I'm expecting a 25.5% move. Well, let's say it moves that dollar, and these are sitting up 25.5% from where they are now. And let's say the delta remained the same, and it moved another dollar. I'm just going to expect that I'm going to make another 25.5% from whatever that current price is. Keep it simple. Don't let it confuse you. Because those same people that like to spend a whole bunch of time telling you about all the Greeks and what they mean, and this is what you do, and this is how you do it, the best email that they can send out to advertise their service is to brag about the big 60% swing trade they made. That's the best advertisement they can send out. Look at our big 60% swing trade. Have I made 60% swing? I really don't like to talk about those. Those are embarrassing when it comes to options. But that's what others who try to spend a lot of time acting smart, yet they still work full-time jobs because their trading's not that good. Especially when that full-time job's a teacher at an elementary school. So yes, when that's your life, you're going to brag about a 60% swing trade. I didn't send out no emails today bragging about an 88% swing trade that only lasted a couple hours. Because if it doesn't go over 100%, it ain't worth bragging about. Right? It's nice to see your account go up. But if it don't go over 100%, it's not worth bragging about. And I'll be darned if I'm going to send out something bragging that we just made some big 60% swing trade. That would be something that you would leave a bad testimonial about. Seriously, we're only making 60% swing trades? That's the best one you have to offer? But you know, all the talk sounds really smart. It's the execution that's off.